Hi, I'm Lance Roberts with realinvestmentadvice.com. Also, I'm the Chief Investment Strategist for Clarity Financial, and I just wanted to take a few quick minutes here just to talk about the markets. I know there's a lot of concern after the recent correction that, this is the big one, right? This is the Sanford and Son, the big one, and I'm coming home, Elizabeth. It's not. Just relax here for a moment. I want to go over a couple of things here. We've been talking about now and writing on Real Investment Advice about the coming correction. We knew one was coming. We've talked about this massive deviation that existed between the price of the market and the 200-day moving average. And we discussed it several times. I've written about it multiple times in our newsletter and on our website. And I warned that the correction, when it came, was going to feel a lot worse than it actually was, simply because it had been so long. We'd gone a record level of historical time frames with without 1% correction or even a 3% correction. So having something of this magnitude, it seems terrible. And I get it. Emotionally, we just all want to panic and sell stuff. Let me encourage you not to do that. A couple of things we want to cover here is that simply, yes, the markets have corrected. And as I had said before, we had this massive deviation that hasn't previously existed between the market and the 200-day moving average. And yet, over time, moving averages act like gravity. And the further that prices get away from moving averages, they eventually want to revert back to them. These are called reversions to the mean, something we've written about on our website as well. But just recently, the market did try to broke the 50-day moving average and then bounced back towards it and failed. Now, that's a bearish signal, and this was a level where we actually added to our short positions in our portfolios, so our clients are seeing this action being put in. This decline that broke this bottom is also a very bearish signal at this point, and why we are still long our short position currently. Now, the big issue, though, is this 200-day moving average that we haven't broken yet. Now, we are going to probably work our way towards this 200-day moving average. We actually got close to it yesterday. We're likely going to bounce today a little bit, but a bounce here that fails at the 50-day moving average, comes back down and breaks this recent low, is probably going to test that 200-day moving average. Now, a violation of this 200-day moving average right here is going to be something much more important that we need to be paying attention to as investors, because this is going to signify that the market's under a bigger correctionary or a bigger reversion process that takes us back to weekly and potentially even monthly moving averages, and again would signify a bigger market correction that is in process, potentially a change from a bullish trend to a bearish trend. We're not there yet. We are still clearly within the bullish trend. This 200-day moving average has been a very good indication of the bullish trend over the last 9 years. We have maintained primarily above that this entire last 9-10 years. So again, we want to honor that level here. This is just a correction process momentarily. May be a good buying opportunity at some point if prices are able to hold support at this level, not lose that level, and then begin to recover and repair, move back above the 50-day moving average. That would also be indicative of a return to the bullish trend, which would be fine for investors and portfolios going into the rest of this year. I do have to warn you, though, that this is potentially, we are 9 years into a bull market, and we're at a point in time where interest rates have been moving up. And this issue has been a question, is exactly at what level do interest rates tend to trip up the market? And that's been about 2.9%. Bonds now, as opposed to stocks are not really oversold to a great degree yet on a weekly or monthly basis, but they are in the correction process. Bonds have also been in a big correction process. They're now at a very, very big deviation to their long-term moving average on the other side. So in other words, the next buying opportunity may actually be buying fixed income relative to bonds, particularly if this market does get into a bigger correction. We would expect to see a flight to safety into bonds and into interest rate sensitive investments. So again, I don't want you to panic here. I want you to pay attention to what's going on. We're watching this very carefully. We're going to be updating our website in our newsletter this weekend, as well as in our blog post on Tuesdays. Make sure you're subscribed at the website, realinvestmentadvice.com. We'll email those to you, so we'll keep you up to date as to what's happening with the markets in our portfolios and what you should be doing with your money. Again, I'm your host, Lance Roberts, and it's realinvestmentadvice.com.